Imagine watching a stock chart in free fall. The price is dropping fast, panic is setting in, and then, suddenly, it hits an exact, seemingly random dollar amount, stops on a dime, and aggressively shoots back up. These sharp reversals happen even when there is no breaking news or massive group of investors working together to save the stock. These bounces are driven by a hidden mathematical boundary programmed directly into the market's plumbing. Professional traders call this barrier the put wall. Whether a stock safely bounces off this level or crashes right through it is the single most important factor in determining how bad a sell-off will actually get. To understand how this works, picture a massive, heavy-duty trampoline stretched tightly across a deep canyon. The fabric of this trampoline is woven out of thousands of financial contracts called puts. You can think of a put like an insurance policy that massive financial institutions buy to protect themselves when they expect a stock's price to drop. Over weeks and months, thousands of these insurance policies pile up and cluster around one highly specific price point. That massive concentration of contracts creates a localized area of extreme financial tension. If you can locate exactly where this financial trampoline is stretched across the chart, you know exactly where the largest players in the market have placed their safety net. But who exactly is building this trampoline? They're called market makers. These giant financial institutions act like the dealer in a casino, providing the stock shares and cash needed for everyone to buy and sell. Market makers don't care if a stock goes up or down. Their goal is complete neutrality. They make their money on the transaction itself, not by guessing the direction of the market. Selling thousands of put policies dangerously tilts their portfolios. To protect themselves, strict rules mandate balance. As price falls toward the put wall, algorithms force market makers to sell shares. This counterintuitive protective selling speeds the stock's drop, driving it directly into their own trampoline. If the market's biggest players are relentlessly selling and pushing the price down, why does the stock bounce instead of dropping straight to zero? The answer is a mechanical limit. Once the stock drops to the exact put wall price, those thousands of insurance policies reach maximum capacity. At that precise threshold, the math changes. The algorithms instantly command the market makers to stop selling stock. They have all the protection they need. Removing this downward pressure acts as a physical release. The trampoline reaches maximum flex, buyers step in, and the stock forcefully snaps back upward. A sharp bounce off these levels is rarely a stroke of luck. It is a highly predictable, mathematical reaction built into the options market structure. But there is a catch. This floor is sturdy, but under the wrong conditions, it can instantly become a trapdoor. We have to look at what happens when severe, overwhelming market panic drives a stock's price completely through the fabric of the put wall. The moment the price slips underneath that wall, the market makers are stuck holding on to protective trades they no longer need to balance their accounts. Their own rules now force them to get rid of those positions as fast as possible. This means the biggest institutions in the market suddenly turn into aggressive sellers. This is the trapdoor effect. The structural support entirely vanishes, and instantly a massive wave of selling pressure is dumped onto the market. The stock enters an unhindered freefall. With the trampoline broken, there are no mechanical forces left below to slow the descent. When a stock breaks decisively below its put wall, you are looking at a serious warning sign. The safety net has morphed into an anchor, pulling the price deeper underwater. You do not need a background in advanced mathematics to see where these critical levels are hiding before they get tested. Because market makers follow these rigid, predictable formulas, we can use computers to scan every insurance policy in the market. By totaling them up, software can pinpoint the exact price where that trampoline is strongest before the trading day even starts. Having that precise number turns a chaotic, unpredictable stock chart into a clear, strategic map. It gives you two very straightforward rules to follow. You can look for safe opportunities to buy when price approaches the floor, and you know exactly when to step out of the way if the trapdoor breaks. Once you understand how these mechanical boundaries work, you stop guessing where a falling stock might land. You can see the structure beneath the surface, allowing you to anticipate the bounce with confidence.